everybody, welcome to Money's No Object. I'm your host, Dylan Howell, and I could not be more excited to continue sharing personal finance topics that I think can be useful for you in your long-term financial journey. Today, we are going to be talking about inflation, right? So I want it to be something that is relatively simple. And if you know what inflation is, you understand inflation, then by all means, move along, okay? I'm not going to be mad at you, but right? If you want to learn more about inflation, how inflation impacts your life, what inflation is, how it's measured, all these different types of things, then stick around. And I know inflation is very relevant to our life today, especially, right? So I want to be very clear. I want to be very upfront and to help you to understand this buzzword that you keep hearing go around, and to understand that inflation is not just the price of gas increasing, right? Inflation is much more than that. And many of you may know that, but some of you may not. So just stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Well, nowadays it seems like it's in every headline. All right, it's all over Fox News. It's all, Biden inflation or, whatever, right? Inflation is a buzzword, right? And one of the big reasons why inflation is a buzzword is because we haven't seen inflation like we see today in a long time, right? In 30 plus years has it been since we've seen inflation the way that we see inflation today. And is inflation always a bad thing? No. And we'll get to that, right? But I really want you guys to understand what inflation is and what it means, why it's important, right? Why we even take time to look at it. Because without, knowing exactly what inflation is, then how can we make it make sense? How can we make it matter? Okay? Just to give you some historical context, right, of what inflation has been over time and how big an increase in inflation we have recently seen, right? If you just go back to 2011 had the highest annual inflation rate over the past 10 years other than 2021, right? And that was a 3% annual inflation rate, meaning the prices of all goods and services in the United States on average increased by 3% that year. But in 2021, it increased by 6.8%. So that's a 3.8% difference relative to 2011, which was the previous high over the past 10 years, right? But some of the biggest readings that we have seen on inflation in a long time happen in 2021, right? You just look at all the monthly inflation readings that you've seen since the year 2000, right? And you can't really find any that come close. Yes, there's, 5.6, 5.4% in the middle of 2008, right? But we hit 6.2, 6.8% here in 2021, right? So these annualized numbers are pretty high relative to anything that we've been used to, okay? But what does this mean, right? Why does it matter? What is it? Well, inflation is the decline of what we call purchasing power of a given currency over time, right? And inflation is just based on one specific currency. So here we're talking about the dollar, let's say, right? And purchasing power is how much you can purchase with some fixed amount of currency, right? If I can take $100 and buy a certain amount of goods and services, right? And then later I can't buy the same goods and services with that $100 because the prices have increased, then my power to purchase something with that $100 has decreased, right? My purchasing power has decreased. So a quantitative estimate of the rate at which the decline in purchasing power occurs can be reflected in the increase of an average price level of a basket of selected goods and services, right? And this is just in an economy based in a certain currency over some fixed period of time, right? The rise in the general level of prices, often expressed as a percentage means that a unit of currency effectively buys less than it did in prior periods, right? And this happens in the United States. Now, inflation can be contrasted with deflation, which occurs when the purchasing power of money increases and prices decline. Now, this is far less common, especially in the United States, but it has happened in the past, especially in small amounts and during recessionary times, okay? Now, while it's easy to measure the price changes of individual products over time, human needs extend beyond one or two such products. Individuals need a big and diversified set of products as well as a host of services for living a comfortable life. They include, commodities like foods, grains, metals, fuels, utilities, electricity, transportation, services like healthcare, entertainment, labor, right? Inflation aims to measure an overall impact of price changes for a diversified set of products and services. So this is useful, right? It's useful that it doesn't just track one thing or one set of things. It tracks many different things in an economy over some period of time. Now, as a currency loses value, prices rise and it buys fewer goods and services. This loss of purchasing power impacts the general cost of living for the common public, which ultimately leads to a deceleration in economic growth. Because naturally, right, what a lot of people call inflation and the historical definition that so many people use, especially on news outlets, is too many dollars chasing too few goods. Okay, that's inflation, right? You have too much money chasing not enough of something. And what happens over time naturally is prices are going to rise based on that fact, right? Now, many may argue that that's, demand pull inflation and that doesn't always happen, but nonetheless, right? The consensus view among economists is that sustained inflation occurs when a nation's money supply growth outpaces economic growth. You may say, oh, well, there were some keywords there that are very, buzzy nowadays, right? Money supply growth and economic growth. Okay, money supply has definitely grown. How do we know, right? Well, a lot of money has been pumped into the United States economy. Of course it has, right? Whether it be stimulus checks, whether it be the quantitative easing that has occurred, whether it is any number of things, right? The Fed has thrown money into the economy. The government has thrown money into the economy. The money supply has grown. Now, the question is it outpacing economic growth? Some may argue yes, right? And that's why we are seeing more sustained inflation than we may have thought, right? So just to give you a very simple example of inflation, how has inflation changed a price of the cup of coffee over time? In 1970, 25 cents. 1980, 45 cents. 1990, 75 cents. 2000, $1. 2010, $1.25. 2019, $1.59. Now, even though we saw that increase in prices over time for something like, a cup of coffee, it didn't happen for all assets and it didn't happen for all things in the exact same amount. So it's important to remember when you're talking about inflation, that inflation impacts different things in different amounts over time. Now, to combat inflation, to combat you having the growth of a money supply outpacing economic growth, a country's monetary authority, like the Fed, right, takes the necessary measures to manage the supply of money and to keep inflation within permissible limits and keep the economy running smoothly, right? That's one of the Fed's jobs, right? It is to maintain stable prices. Okay, so that's keeping inflation within certain limits. That's why they talk so much about inflation and they have such a big impact on inflation. Now, theoretically, monetarism is a popular theory that explains the relationship between inflation and the money supply of an economy. For example, following the Spanish conquest of the Aztec and Inca empires, massive amounts of gold and silver especially flowed into the Spanish and other European economies. Since the money supply had rapidly increased, the value of money fell, contributing to rapidly rising prices. Inflation is measured in a variety of ways depending on the types of goods and services considered, and is the opposite of deflation, which is the general decline in the price of goods and services, right? And this happens when inflation falls below 0%. Okay, now, there can be many causes of inflation. It's not always a government pumping money into an economy, even though that's very likely what we're seeing now, on top of supply chain issues that are leading to increases in costs as well, right? Because all of this comes back to, very simply, a supply-demand curve, right? And what do we know about supply and demand? We know that when there is less supply, right, sustainably less supply, right, then there are going to be higher equilibrium prices, okay? Because you have a set amount of demand that's trying to get a certain amount of goods, but there's less supply of those goods, so the goods are going to cost more. Okay, makes sense, right? If the opposite happens, if supply increases, meaning you have a lot of things, right? Think about something that you may, create, or something that you may want to sell, that you have a ton of, right? Well, you may not be able to sell them for very much. So for instance, just think about the art world, right? There's so much art out there that a lot of it is worthless, right? But there are some that are very rare, some things that are very, scarce. Therefore, since they are scarce, then what? Then there's going to be higher prices for those things, right? So that's the impact supply can have on, this particular idea of inflation and prices, right? And we see the same thing with, like, let's say sports memorabilia. For those athletes that signed, let's say, just a few autographs during their day, having something that they signed, if they were a great player, is extremely valuable because it's rare, right? But if somebody signed a ton of stuff, even if they were great, it's not going to be as valuable, okay? That's the idea of supply impacting the price of something. But what about demand, right? When everybody was at home during COVID, right? Not many people were on the roads, okay? Everybody was just quarantining. Well, demand decreased. And when demand's lower, then what happens to prices? Prices decrease. So we saw the price of gas do what? Go down precipitously, right? But then what have we seen since? We've seen demand surge, and when demand surges, then what happens? The price of that commodity has increased, okay? So no surprise that everything just ties back to this supply-demand curve, okay? So if you've taken economics and you didn't pay attention, that was your quick supply-demand lesson. Now, causes of inflation, right? An increase in the supply of money is at the root of inflation, okay? Though this can play out through many different mechanisms in the economy, this is the root. Money supply can be increased by the monetary authorities, either by printing and giving away more money to the individuals, by legally devaluing the currency, by loaning new money into existence as reserve account credits through the banking system, by purchasing government bonds from banks on the secondary market. All these things, all these ways are ways in which the money supply can be impacted. In all cases, right, the money loses its purchasing power, right? You can purchase less goods than you could before with the same amount of money. The mechanisms of how this drives inflation can be classified into three types: demand pull inflation, cost push inflation, and built-in inflation. So let's first talk about demand pull. Okay, this occurs when an increase in the supply of money and credit stimulates overall demand for goods and services in an economy to increase more rapidly than the economy's production capacity. Okay, this is where you have demand, right? You have all this demand, like I was saying, right? And demand may impact the price of goods and services, right? The increases in demand lead to higher prices. Okay, with more money available to individuals, positive consumer sentiment leads to higher spending, and this increased demand pulls prices higher. So, for instance, stimulus checks, right? You get a stimulus check, then what's that going to do? That's going to make you want to go out and buy stuff, right? So there's going to be higher demand for the stuff that you went and bought with your stimulus check, right? Therefore, prices may rise, right? Because there is new money in the economy, and it is creating more demand, and that higher demand is going to increase prices. Now, what about cost push? Cost push is a result of the increase in prices working through the production process inputs. Okay, when additions to the supply of money and credit are channeled into a commodity or other asset markets, and especially when it's accompanied by a negative economic shock to the supply of key commodities, costs for all kinds of intermediate goods rise. These developments lead to higher costs for the finished product or service and work their way into rising consumer prices. Aha, right? So something else we can look towards and go, I understand this because we see it unfolding in front of our eyes, right? What about the ability to have semiconductors, right? Chips for vehicles, for phones, for iPads, for all types of electronics that we use, right? Well, the economic shutdowns in some of the Asian countries has led to this place where we don't have them, right? Therefore, the things that do have them, that we do have, are being marked up in price, right? So let's just say like the cost of a vehicle, right? We've seen vehicle costs increase because what? Because vehicles need semiconductors to run in the way that they do, to run the technology, right? So you've seen the increase in used car prices skyrocket because there's not any new cars over here, and the cost of actually having those semiconductors is rising extremely fast, okay? So that would be an example of cost push inflation, right? Higher costs to actually get those semiconductors, right? So that's going to push inflation higher. Then what about built-in inflation? Okay, this is related to adaptive expectations, the idea that people expect current inflation rates to continue in the future. All right, as the price of goods and services rises, workers and others come to expect that they will continue to rise in the future at a similar rate and demand more costs or wages to maintain their standard of living. Their increased wages result in higher costs of goods and services, and this wage price spiral continues as one factor induces the other and vice versa, right? Because if prices rise, then wages are going to have to be higher in order to keep up with prices, right? And then naturally, if wages are rising, right, if you're getting big increase in wages, then prices are going to rise from these companies that know that they can make the same margins on consumers, right? And so this is just built-in inflation into the economy. Now, inflation did not happen in the way that it does today when the economy was on the gold standard, right? We were on the gold standard for many, many years. And then when we decoupled from gold and became a fiat currency, meaning that the currency itself is just, backed by the full faith and credit of the U.S. government. It's not, backed by any hard asset. It's just a dollar bill or just a 20 or just a 50 or whatever, right? And so now inflating the currency is quite easy because you just basically press print. You just push money into the economy. It's far easier, right? You don't have to have the gold that backs up that particular amount of currency, right? So it's very, very different than it used to be. Now, how is inflation tracked, right? How do we determine what the inflation rate is, how it has changed? Well, there are price indexes that do this, right? And the most common, and I'm really going to focus on two. I'm going to focus on the CPI and the PPI, right? The CPI is the Consumer Price Index, and it measures the weighted average of prices of a basket of goods and services, which are primary consumer needs, right? They include transportation, food, and medical care. This is calculated by taking price changes for each item in the predetermined basket of goods and averaging them based on their relative weight in the whole basket. The prices in consideration are the retail prices of each item as available for purchase by the individual citizen, right? So this is what we typically look at, changes in the CPI when it comes to how we say inflation has increased. So changes in the CPI are used to assess price changes associated with the cost of living, making it one of the most frequently used statistics for identifying periods of inflation or deflation. In the United States, the Bureau of Labor Statistics reports the CPI on a monthly basis and has calculated it for as far back as 1913. Okay. Then there is the PPI, the Producer Price Index. Now, this is a family of indexes that measures the average change in the selling prices received by domestic producers of intermediate goods and services over time. This measures the price changes from the perspective of the seller and differs from the CPI, which measures the price changes from the perspective of the buyer, right? So not only do we want to know how the consumer is impacted by the cost, we also want to know how the producer, the seller, is impacted by the cost as well, right? Now, in all such variants, it's possible that the rise in the price of one component, say oil, cancels out the price decline in another, say wheat, to a certain extent. Overall, each index represents the average weighted price change for the given constituent, which may apply at the overall economy, sector, or commodity level. Okay. Now, it's important to note that, like I said earlier, inflation is not all bad, but it's also not great, right? We know as consumers, it's not great when things increase in price and do so sustainably, right? So it can be construed as either a good or bad thing, depending on which side one takes and how rapidly the change occurs. For example, individuals with tangible assets that are priced into currency, like property or commodities, may like to see some inflation as that raises the price of their assets and they can sell at a higher rate. So this is a big reason why holding stocks is good when you see some inflation, because who is increasing the prices of goods and services? Well, the companies that sell the goods and services. Well, if you can own shares of the companies who sell the goods and services, well, their value is only going to increase as they charge higher prices, right? Now, obviously, there's a breaking point there to where if prices get too high, consumers won't buy, and then that'll decrease firm value, right? But a little inflation can be good for the increase in the things, the real assets that you own. However, buyers of such assets may not be happy with inflation as they would be required to shell out more money. Inflation-indexed bonds are a popular option for investors to profit from inflation. On the other hand, people holding assets denominated in currency such as cash or bonds may also not like inflation, right? As that erodes the real value of their holdings. So the best example of this is just a fixed rate bond. If you're getting paid a fixed coupon rate on a bond over time, you're getting paid fixed interest, right? And you keep getting those fixed interest payments. Well, let's say you're getting $50 a year on a $1,000 bond and you're doing so for 10 years. Well, $50 in year one is not going to be equivalent in purchasing power to $50 in year 10. So because you had this fixed rate bond, this fixed payment, right, then the real value of the money that you were receiving declined, right? So that's why bonds are not very good when it comes to inflation, unless you're talking about inflation indexed bonds, which still have their downsides, okay? Now, investors looking to protect their portfolios from inflation should consider inflation hedged asset classes like, gold, commodities, real estate investment trusts, things of the like. But even then, right, you look at this past year or so, there's been inflation. There's no doubt about there being inflation. But what about the price of gold, right? You would be thinking, oh, well, of course, gold must have done well because everybody says, go to gold for, your hedge against inflation. Well, you look back a year, gold is down over the past year. You just look at the GLD ETF. It was a year ago over 170 in price. Now we're looking at 167. You could look at the per ounce price of gold as well. It's also gone down. Okay. So that isn't even really true. So it can hurt you as an investor as much as it may also help you. Now, inflation promotes speculation both by businesses and risky projects and by individuals in stocks of companies as they expect better returns than inflation, right? So when somebody's trying to beat inflation and to make positive real returns, inflation can push you to take more risks, right? Because otherwise you are going to lose money relative to inflation. An optimum level of inflation is often promoted to encourage spending to a certain extent instead of saving. If the purchasing power of money falls over time, then there may be a greater incentive to spend now instead of saving and spending later. It may increase spending, which may boost economic activities in the country. A balanced approach is thought to keep the inflation value at an optimum and desirable range, like the Fed tries to do around the 2% target that they typically have. Now, high and variable rates of inflation can impose major costs on an economy. Businesses, workers, and consumers must all account for the effects of generally rising prices in their buying, selling, and planning decisions. This introduces an additional source of uncertainty into the economy because they may guess wrong about the rate of future inflation. Time and resources expended on researching, estimating, and adjusting economic behavior are expected to rise to the general level of prices rather than a real economic fundamentals, which inevitably represents a cost to the economy as a whole. Even a low, stable, and predictable rate of inflation, which some consider otherwise optimal, may lead to serious problems because of how, where, and when the money enters the economy. Whenever new money and credit enters the economy, it always is into the hands of specific individuals or business firms. And the process of price level adjustment to the new money supply proceeds as they then spend the new money and it circulates from hand to hand and account to account through the economy, right? Along the way, it drives up some prices first and later drives up other prices. This sequential change in purchasing power and prices means that the process of inflation not only increases the general price level, but it distorts relative prices, wages, and rates of return along the way, right? Really, in general, right? I've told you a lot about inflation here, but I want to just break it down really quickly. There's so many things you can learn about inflation, but I wanted you to understand just the basics here. I wanted you to understand how inflation works and how it may impact your life. But something that we need to know, something that we need to understand is that it's not all good and it's not all bad, right? And we need to know that over a certain amount, it can be very bad, and gone unchecked, it can be very bad, right? But we also need to know that for a long period of time, not having inflation can kind of stink too. And the reasoning for not having inflation can kind of stink too. Does that mean we're not growing? Does that mean we're not doing what we're supposed to do? Right? Does that mean the economy is not expanding in the way that it should? Those can all be problems that we have to deal with in a very real way, right? But I wanted you to understand inflation, and I want to end here with some extreme examples because it helps to just drive the point home as to what inflation may look like in examples of it going unchecked, right? So since all world currencies are fiat money, right, the money supply could increase rapidly for political reasons, resulting in a rapid price level increase, right? The most famous example is the hyperinflation that struck the German Republic in the early 1920s. Nations had been victorious in World War I, demanded reparations from Germany, which could not be paid in German paper currency, as was a suspect value due to government borrowing. Germany attempted to print paper notes, buy foreign currency with them, and use that to pay their debts, right? So, of course, this would throw the inflation into a complete skyrocket. So this policy led to rapid devaluation of the German mark, and hyperinflation accompanied the development. German consumers responded to the cycle by trying to spend their money as fast as possible, understanding that it would be worth less and less the longer they waited. More and more money flooded the economy, and its value plummeted to the point where people would paper their walls with practically worthless bills, right? So just imagine dollar bills all over your wall because you don't know, if it'll ever be worth anything. Similar situations have occurred in Peru in 1990 and Zimbabwe in 07-08. Zimbabwe 07-08, I think, is a real interesting one because they were, printing like million, not dollar, but currency in $1 million units, $1 billion units. They were just inflating the currency so much. So ultimately, right, it's something that we need to pay attention to, especially in our investments. You want to outpace inflation. If you are, retiring, you want to make higher rates of return than inflation on your nest egg, or else you are losing over time. You want to make sure that you can keep pulling off of your nest egg in a proper way to keep up with the rising costs of goods and services. You want to be invested in assets that hedge against inflation and that grow with inflation. But ultimately, there's not a whole lot we can do to impact inflation on our own. That is what the Fed's there for, right? And trust them or not, that's their job, not yours, right? And inflation is going to impact us all differently. Even though the inflation rate may be 6.8% annualized, that doesn't mean that it's 6.8% for everything in all of our lives. It just means that is what it's tracked at. But if you go to the grocery store, you go, buy things from retail stores, you see the difference. You know what's going on. You go buy, electronics, tech goods, you understand that prices have changed and likely have changed over the long term, right? It's not likely once prices rise that will change again because wages are going to follow the prices, right? So understand inflation because it's going to be a part of your life as long as you're living in the U.S., as long as you're living in this fiat world. And hopefully I've made it a little more clear to you today what it is, how it's caused, and how it may impact your life. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video. Leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.